In this video, we consider the intergroup sale of inventories. To set up the economic event before going into some scenarios to work out the consolidation journals, let's have a look at the following. A supplier, an external third party to the group, sells inventory to S Limited, the subsidiary in our instance, for R100. The subsidiary in turn sells those inventories to the parent company for R150. The parent company then sells those inventories to a customer outside of the group for R175. There's your economic event. Now considering the accounting in each party's records. Well, in the subsidiary's records, there will be a sale of R150, being the sale from S Limited to P Limited, and cost of sales being the acquisition of those inventories from the supplier of S Limited for R100, resulting in a R50 gross profit for the subsidiary. In the parent company's books, this being the individual records, not the consolidation records, there's revenue of R175 now recorded, being the sale from the parent to the customer. In the parent's books, though, the inventories cost the parent R150 when these inventories were purchased from S Limited. So here you clearly have an account of what happened in the parent and subsidiary's individual accounting records. Now the focus of our discussion is the consolidated financial statements. In our instance, where S and P Limited are viewed as a business combination, are viewed as one entity, the supply of inventories into that business combination is at R100, being the cost of sales, assuming those inventories are sold, R100 to the group. Otherwise, the cost of inventories if they remain unsold. This then flows through the group and is eventually sold to a customer outside of the group for R175, thus realizing a R75 gross profit for the group. Make sure you understand this economic event clearly before you continue with the rest of this video. Pause if necessary, but please spend time making sure you understand the flow through of transactions. In particular, what happens in each individual general ledger, and then what we want to have happened, assuming that the business combination was one entity we are reporting on. Right, given that economic event, let's go through a few scenarios as that event develops. The first scenario will be where S Limited has acquired the inventories for the R100. So in this scenario, taking a similar graph to the previous slide, the supplier now has given or sold inventories to S Limited for R100. The transaction has then ended there. There's been no flow through of P Limited acquiring the inventories from the subsidiary. So let's have a look at the individual accounting records. The parent limited, there is no effect, he has not purchased any inventories. In the subsidiary, he has acquired inventories that are unsold, so they'll be lying in the statement of financial position at the cost to S Limited of R100 in the line item inventories. If we follow the consolidation procedure, P plus S, our combined information then shows us inventories at R100. Consider the group scenario now. In a business combination, we view S and P Limited as one entity. Then we want to account for transactions with third parties. The supplier is a third party. So acquiring the inventories into the group within the red circle of R100 is quite correct. That is the cost of the inventories to S Limited and the cost to the group as well. In scenario 2, let's develop the economic event further. Again, the supplier has supplied inventories to S Limited for R100. S Limited has in turn supplied these inventories for R150 to P Limited. Now we have an intragroup event, S Limited and P Limited. A note now before we continue to explain the accounting. Remember that consolidation journals, your pro forma consolidation journals, usually affect line items. In the previous scenario, therefore, we worked with revenue and cost of sales and inventories, and gross profit as a line item as well. These have been noted now in this example in bold type, but to facilitate the explanation thereof, there has been line items included now for purchases and closing inventories as well. But please remember, when you affect these items, you are actually affecting cost of sales. And what is also important in understanding the debits and credits, cost of sales, yes, is a debit entry. It does reduce your profits. Purchases, that line is also a debit entry. But very importantly, please remember that cost of sales is a credit and it decreases your cost of sales expense, your closing inventories, decreases your cost of sales. That therefore will increase your profits. Please let me repeat to make sure. Cost of sales line item is represented by purchases and closing inventories. We'll get to opening inventories later. Remember, cost of sales is an expense, a debit. That though comprises of purchases, which is also a debit. However, closing inventories is a credit to the T account in the general ledger. That will reduce your cost of sales and that therefore will increase your profits. Please take a moment to think about this. Scribble it on a piece of paper that you remember the effect of cost of sales and profits and the various T accounts involved. If I can crudely on the side here just remind you, that may be your account for purchases. Purchases are recorded in that account on the debit side, decreasing profits. You may then have an account for closing inventories. Closing inventories are transferred to the SFP by crediting the statement of comprehensive income. When you credit something in the statement of a comprehensive income, you are increasing profits. These two accounts, though, together comprise cost of sales. A credit to cost of sales, reducing the expense, but increasing profits. Please take a moment to understand that before proceeding with this video. Right, understanding the cost of sales and how the general ledger, etc. works, let's consider this economic event now in the individual company's books. The supplier has given or sold 100 Rands worth of inventories to S Limited. So in S Limited's accounting records, you will have purchases in the cost of sales line item of 100 Rand. These have then been sold on to the parent, P Limited, for 150. Therefore, you will have 150 Rands revenue recorded in S Limited's accounting records. The sale of these inventories then to the parent is reflected in the parent having purchased these inventories for 150 Rand from S Limited. The parent has not now sold these inventories. In this instance, we have stopped the economic event at this point and we are now reporting on it. Those inventories therefore need to be transferred using closing inventories through to inventories in the statement of financial position at the cost of those inventories to the parents, being 150 Rand. As a result, P Limited has no cost of sales, has no gross profit. The subsidiary, however, is reflecting a gross profit of 50 Rand, being the inventory sold to the parents for 150 that they acquired from the supplier for 100 Rand. Following our consolidation procedure now, we combine the parent plus the subsidiary. There you have revenue of 150 coming from S. You have the cost of sales coming from S of 100. The purchases being made up of the purchases of the parent and the subsidiary being 250. The closing inventories coming through from the parent of 150. And the gross profit coming through from the subsidiary at 50 and the inventories coming through from the parent at 150. Now step back and think about what do we want if we are doing a business combination. Look at your economic event. We have inventories coming into the group from a supplier for 100 Rand that have not been sold to an outside party. Therefore, the answer to this scenario needs to be very similar to the answer in scenario 1. Those inventories have come into the group, they've been purchased but are still on hand by the group, so need to be in the inventories account. So we need to apply consolidation journal entries to achieve this. First of all, your intra-group transaction was the sale of inventories between S and P Limited. So we do a consolidation journal indicated in yellow on your screen for the 150 to eliminate the sale and to eliminate the purchase, which is intercompany. That will now leave you with no revenue for the group. It will also leave you with 100 Rands purchases for the group. And this is quite correct because the supplier sold inventories to the group for R100. Where there is, however, still a problem is the closing inventories in our combination is R150 coming through from the parent. The closing inventories for the group, though, should be those purchases at cost to the group, which is 100. We therefore need to do a consolidation entry for that profit in the group for 50 Rand, being the 100 and the 150. That 50 Rand there has not been, the word we used is realized outside of the group. So you need to basically reverse that profit. So we do one more consolidation journal entry to get our closing inventories back to the cost to the group. Once this consolidation journal has been processed, your closing inventories are now reflected at the 100 Rand to the group and in the statement of financial position, 100 Rand. Is that what our scenario told us? Indeed it is. 100 Rand was purchased and has not yet flowed through to a third party. Please take a moment now just to play this slide through in your head. Write it down on a piece of paper and make sure you understand it thoroughly before proceeding to the next scenario. Right, following on from scenario 2, we now have scenario 3. Again, let's look at the economic event. The supplier has sold inventories to S Limited for 100 Rand. S has sold these on to the parent company for 150 Rand. And now in our instance, what we are adding on is that the parent has now actually sold these on to a customer for 175 Rand. So we are looking at business combinations. What is the effect if S and P Limited are regarded as a single entry? Well, the supplier sold them inventories for 100 Rand. The group has sold them to a customer for 175 Rand, meaning we need a 75 Rand gross profit for the group. Let's have a look how we get there. Again, in S Limited's books, there will be the purchase of the inventories at 100 Rand, recorded in the cost of sales. These are then sold for 150 Rand to the parent. The sales then to the parent are the parent's purchases, 150 Rand. The parent has now sold these to an external party for 175. So there is the accounting in the individual records of each of the entities prior to consolidation. Now we combine them to begin our consolidation process. So there's 175 Rand revenue and 150 Rand revenue in the combined total. There's cost of sales of 150 and 100, purchases of 150 and 100, ultimately giving you a gross profit of 75. In this instance, there are no inventories as they have been sold out of the group and are not on hand anymore. Now clearly that combined column there does not yet reflect what the scenario for the group would be. We are looking for a cost of sales for the group of 100, sales for the group of 175, resulting in a gross profit to the group of 75. How do we get there? Pro forma consolidation journals. And quite simply, in this case, it's a case of eliminating the transaction between S and P Limited. So our consolidation journal is the 150 Rand against revenue, 150 Rand against purchases. Eliminating that intergroup, as shown in yellow, will result in the correct final consolidated figures. There's no need now to adjust the profits that may be included in inventories on hand, as there are no inventories on hand to worry about. Now for our final scenario, and one where you may need to really keep your wits about you. We consider the movements between periods. So what is going on in this scenario? We have the year 20x1, the first year that we're considering. And in that year, the subsidiary has purchased inventories for 100 Rand from a supplier. The subsidiary has then sold those, as in scenario 2, through to the parent for 150 Rand. And that is then where year 1 has ended. We now have a reporting date. So in this instance, you can refer back to your understanding of scenario 2. Then we develop the scenario further, and we then say the second year arrives, denoted in the dark blue here. And in the second year, the parent ultimately sells these goods to the customer. There is your economic event. Please take a moment to understand it before watching the video further. Understanding your economic event now, relate it back to the group. What do you want to have achieved? Again, this is denoted here. Ultimately, the group must realize a gross profit of 75 Rand, with a cost of sale of 100 and revenue of 175. Now focusing on our first year, which is the same as scenario 2, so forgive the brevity in the explanation. You have the intergroup sale of inventories for 150 Rand from the subsidiary to the parent. The subsidiary therefore is showing a gross profit in the first year of 50 Rand, being the inventories acquired for 100, sold onwards for 150. The parent company has not yet sold those, so has transferred those inventories to inventories in the statement of financial position, denoted in the two green blocks. These are combined for consolidation. The yellow blocks are eliminated, being the intragroup sale of inventories with a pro forma consolidation journal, and then the closing inventories, which for the group purposes need to be at 100 Rand, but are currently sitting there at 150 Rand because of the parent's books. That 50 Rand extra needs to be reversed, as that profit has not yet been realized outside of the group. This is exactly the same as what we did in scenario 2. That will result in your final figures being 100 Rand purchases for the group with 100 Rand closing inventories transferred to the statement of financial position. You need to be comfortable now with that before proceeding now to the second year. Now, it's important to remember that with consolidation, the pro forma consolidation journal entries do not carry through from year to year. There is no ledger for the group for them to carry on from year to year. So each year you need to start in the same place, being the individual company's records. So let us now consider the second year. What has happened in the second year? Remember now, P Limited had inventories on hand of 150 Rand. P Limited sold these inventories to an external customer for 175 Rand. So in the accounting records of the parents, you'll see there's revenue for 175, the 150 Rand of the inventories purchased last year and was sitting in the statement of financial position for the parent as an opening balance has now been transferred from opening inventories up to the cost of sales at the beginning of the period. That therefore being your cost of sales 150 with a sale of 75, showing you a 25 Rand profit. Please take a moment just to understand this before we proceed again with this video. So to briefly recap, what happened in the parent company's books? Well, the parents had opening inventories on hand of 150 Rand from the previous year in their ledger. They transferred these inventories at the beginning of the period to opening inventories in the statement of comprehensive income. These inventories were sold to a customer for 175. Now, in the subsidiaries records, what happened last year? In the individual records, the subsidiary realized a gross profit last year of 50 Rand. The general ledger in the subsidiaries books carries on perpetually, so that 50 Rand gross profit last year, the effect thereof will now be in retained earnings at 50 Rand. So that is your opening balance, and that is the effect of this economic event, ignoring all other transactions in the individual company books. Again, please take a moment to make sure you understand the individual accounting there. There's no consolidations to worry about. Just make sure you've understood the acquisition and the sale of inventories in 2 years between P Limited and S Limited. Pause the video if you need to take time, rewind if you need to, understand what's happened in P and S before proceeding. Right, having understood what is happening in the individual books, now we need to consider what's going on for consolidation purposes. Well, for consolidation purposes, the sale has only taken place this year. If the consolidated accounts had a general ledger, there would have been opening inventories of 100 Rand. These would then have been transferred to opening inventories and then sold ultimately for 175. However, there is no general ledger for the group, so that cannot be our starting point. That's where we want to get to, and that can be clearly seen here in our final column. We want revenue of 175, we want cost of sales of 100 with no inventories on hand, assuming again this is the only transaction. How do we get there? We follow our consolidation process. So, you've got your individual company's records for the parents and the subsidiary. You combine these. Then we step back and have a look. What is all right so far? Well, we want to show revenue of 175. And indeed, we are showing revenue of 175. We want to show cost of sales of 100. There's a problem. We are not currently showing cost of sales of 100. We have the 150 being the parent's cost of sales. So clearly that needs to be adjusted. Another problem that we have is we are showing a retained earnings of 50 Rand. The group would not have retained earnings yet, as the group has not sold these inventories in the previous period but in the current period. But how simple is that now to fix? You have a problem of an overstated cost of sales of 150 and overstated retained earnings of 50. Very simple, consolidation journal entry, move the 50 Rand to where you need it, and now your resultant answer after that pro forma consolidation journal is exactly what you want to have. Please take a moment just to consider what we've just done. Write it down for yourself on a piece of paper. What I do want to add at this point is that all you have effectively done now is the group wants a 75 Rand gross profit recorded in year 2. The subsidiary has, however, recorded 50 Rand of that gross profit in 2001 or 20x1. So all you need to do is shift that profit for consolidation into the current period. I'll say it again. Your subsidiary made a profit last year of 150. This is in the current period's retained earnings. For the group, we want that 50 to be part of our profit in the second year. So we shift it with a consolidation journal entry into this year's income statement. It's very important in understanding inventories that you know what happened in the individual books. You know what your target is, where you want to get to in the final consolidation. And from there on, it is quite simple to work out your consolidation journal entries. Just as a final comment on this, the effect on non-controlling interest. Remember, you need to ask yourself the question, have I changed the profit of the group? When there is a consolidation journal that moves things between the statement of financial position and the statement of comprehensive income, yes, you have changed the profit of the group. Now ask yourself, who caused that? Well, it's a 50 Rand from the subsidiary being moved through. So that 50 Rand is an effect of the subsidiary, so your non-controlling interest will need to be adjusted for these transactions, as it is a gross profit affected by the subsidiary that we are moving for consolidation purposes.